We're going to talk today about index funds, a little bit different to the normal channel spectrum. So if you like this sort of stuff and you are new to the channel, make sure you have subscribed. If not, just hit the like button, it does help. So my channel is normally cryptocurrency based, but I'm looking to, explore and do what I do normally. Okay, so I've done index funds since 2015, a long time ago. So I want to explain what they are in basic form. So this is like a beginner's guide, mainly for the UK, because I am obviously from the UK. Some of the stuff, what we have versus the America or even in Europe, have different tickers, right? But the fundamentals are pretty much the same. My first level of understanding actually came from this book here. This book is called The Little Book of Common Sense of Investing, right? And essentially it was created by the founder of Vanguard, right? So you've probably heard of Vanguard. Vanguard are pretty well renowned in the space. They're affordable, they're really, really good, and I do use them, right? And this book emphasizes on a lot of points that I've taken into the crypto world and obviously into the stock market investing world. One big quote, and it's a very, very good one, and I use it today in cryptocurrency, is don't look for the needle in the haystack, buy the haystack, right? So what does this mean? It's pretty simple. An index fund is everything. So I'm going to explain it via dog biscuits. Yes. So we have some dog biscuits, right? We are going there. Inside this dog biscuits box, we have a number of different things, as you can probably see. There's a lot. Now, there's also different shapes. There's different sizes, different colors for each available kind of dog, really. And I'll pick out three. Here's three shapes. Now, you've got a heart shape. That could be renowned for something, maybe like tech stocks. You've got like a house, like a kennel. That could be for health. And then you've got a bone. That may be the hospitality, the food industry, right? There's all kinds of other industries as well. But we'll keep it simple. Within that box, it is a basket of everything. It's all of it. And the fundamentals are clear. You are not holding one thing. You are holding everything, right? So you may have, a fund that specializes in technology. You may well be holding Microsoft, Apple, Nvidia, Netflix, all kinds of stocks in one place. Same with healthcare. Same with, real estate. There's loads, right? With that, it's important to know one asset will not bring it down. If they all do bad, yes, they will. And ultimately, that's where the problems lie, if they all do bad. So yes, you can lose money on these, but over the course of time, and we will go over how to track performances throughout this video. So why index funds? Well, they do have attractive returns. Most of the time, about 10% plus every year. Some years are a loss, obviously. Non-financial advice, you are going to lose money potentially some years, but the history stacks out over time. Index funds are over a long period of time. People always come out and say, oh, if you bought the S&P 500 in like 1930 whatever, you'd be a millionaire right now. Yes, you probably would be, but you'd probably also be dead. But that's the thing. You've got to look at these long term. So as I said, you are holding a lot of things. So this box could be one whole index fund with all kinds of different things. In here, there's probably, there's 800 grams of random treats, right, for the dog downstairs. Don't worry. She's not going to bite my arm off them. The end of the day, it's down to you. And one thing about it is diversification. You got 5 different shapes in there, but within an index fund, you will probably most likely have different companies. A lot of them, as you can see by this. You can see the spread. So diversification is huge. Some of them, if it's the S&P 500, you get 509 stocks. If it is the whole entire market, roughly between 4,000 and 5,000 different stocks. A lot of them. If you're doing specialism ones in dividends, you'll get paid a dividend, but you're only focusing on dividend stocks. Make sense? Cool. Another thing as well, kind of with the diversification and with the attractive returns, not much risk really, right? You're not holding an individual asset, you're not going all in. There is risk, don't get me wrong, but holding, say, 10 stocks, hoping they all do well versus 4,000, a little bit different. It's diversified, right? And that is an important thing. Another thing that is often, I feel, overlooked, and it is a good thing, it is a massive plus point in my opinion, low cost. Sometimes the cost is ridiculously low. You could be spending $3 to $10 per year on this fund alone versus multiple trading fees, multiple things. Some of them are passive, some of them are active, some of them you're just tracking the whole of the market, which mainly index funds are, just tracking the market, for example, like the S&P, the NASDAQ, the total market cap of the entire industry. They're good. They are low cost. Sometimes, though, the active ones, where they'll do certain things within that and adjust the fund, a little bit more cost, but realistically, it's a lot less than going down to your financial advisor and do it for you. Trust me, but you need to know what you're doing, which is what this video is all about. So let's go on to the next bit, which gets a little bit more interesting. How do you actually do it? So in the UK, there's quite a few places you can do it, right? You got Vanguard, which I use. You've got, Hargreaves Lansdown. There's Interactive Investor. You can actually do it on the likes of eToro as well. Trading 212. You got iShares. You got Fidelity. You got loads of different places that do it, right? At the end of the day, it's up to you, right? If you're in different countries, you have to do your own research, but it's easy. It's accessible. You can do it via a click of a button. However, throughout this video, we need to talk about research. We need to know how to look at what's in a fund, why funds are good, which ones are bad, which ones are more for your style. There's different risk appetite. You may go from risk 1 to risk 6, for example here. Just a random example. Higher the number, the more risk it is. But at the end of the day, if you do enough research, you'll be able to see exactly how they do every year. What, companies, what spread of companies are within them. When do they do payouts? Tax mitigation against certain things. Now, one thing about this is you can help your tax bills by being involved in index funds. It's one of the great tax efficient ways of doing it. If you are basically like, in the UK, personal contributions, if you got a pension, for example, you can get tax contributions. If you do it via other ways, which I usually do it via pensions, it is a hugely important thing because you can get a nice little blowback back off the government, which is good to know that you can get some money back. So there's a lot of things. Now, what we're going to go on to now is basically on the screen, right? This is how you can track essentially a simple kind of product, right? An index fund. And this is essentially all world high dividend yield, right? And the ticker is there, right? As you can see on the screen. It's pretty simple, pretty straightforward. Now, at the end of the day, this is all up to you. Now, this is the portfolio data. We have got 1,779 stocks in here. They're all dividend-based ones, right? And you can see roughly the regions of exposure. And when you scroll down to the bottom here, you can actually see what the weight of it is. So you've got financials, consumers, you've got healthcare, industry, you've got technology, energy. The list is endless, right? Real estate at the bottom. And then you've got obviously some of the companies. So some, Johnson & Johnson, JP Morgan, Chase, etc., etc. Obviously, they're pretty high up. Why? Because the financial market is pretty much a big weight of this one. So that helps you there. Moving on to the next bit, and something of interest is when is the payment distribution, especially on the likes of dividends. So you'll know roughly when you're going to get your little bit. And again, we're talking about cost before. Cost data, ridiculously low. Ridiculously low. And then obviously the one that you all want to know. You all want to know this one. Price performance. So you see 2017-18, we had a 13-14%, give or take. Some losses there over the last, those 2 years. And then 17% and then 12%. Sometimes they do much better than this. This is just a dividend example, just to give you a little bit of a tease and a taste of what you can do. Now, if you don't have Vanguard, for example, you can also go into different websites. You can look on screeners. There's multiple ones. There's like 13,000 different funds in and around the world in different countries. There's loads of them, right? But they're all doing different things. You've got to go for the biggest and the best. You've got to do your research, which is obvious in terms of this video. There's a good website here, and I find this really, really good. It's actually just ETF, right? So this is the same thing. It's just a bit better in terms of layout, right? So as you can see here, you can see the risk factor and stuff like that in terms of how much of the fund size, the volatility as well, which is hugely important. The bigger the funds, usually better they are technically because a lot more money's in them. Makes much more sense. And you can see here, again, you got the data of how well it's been doing. Over the last 3 years, you're not done too bad realistically, let's be honest here. And again, the weight is all here. Very, very easy for you to see. The best thing for me is to always look at returns. Obviously, they're not going to be perfect, but if you have something that's going to make you more money in the last 5 years, usually a good thing, right? Usually a good thing. And you need to look at that. You need to look at those periods. And you can see over the last 3 years, a decent chunk of money. And will you get that in a bank? No, will you? Hell, you got to be honest with yourself. Will I get that in a bank? No. But there's always risk. Now, in terms of tickers, you can see scrolling down, if you wanted to get involved in this one and you're in different countries, you can see the different tickers. So for me, it is this one because I am in the London Stock Exchange, okay? So that helps. In terms of this website, if you go onto the screener, you can do it by categories if you want. It's entirely up to you. And obviously you can scroll down and you can see all the different categories. For me, I tend to just kind of focus on Vanguard. Because we get to see what they're doing and stuff like that, which is always good. But obviously it's entirely up to you. So for me, if let's just say United Kingdom, if I wanted to look at mid caps in the United Kingdom here, you can see here that what they are. This one's not doing very well. You can see that it's had a great 2019, not a great 2018. And then the year to date, it's down quite a lot, but you got to think the stock market has been pretty terrible. Another example, possibly, let's have a little look at this one. Just to give you an idea. So all cap sort of stuff. So let's have a little look at. Ooh, here we go. This one could be an interesting one. So this is the Global All Cap Choice Index that tracks large, medium, and small cap stocks. So this will probably have quite a lot in it in terms of how many different stocks. So there you go. You can see 1,920 stocks within this. You got Apple as the biggest weight, Microsoft, etc. This is just giving you an idea. Obviously, you must do a little bit more research. This one hasn't been around for that long, as you can see, but overall, you get the idea. This one is a very, very new fund. So again, if you're doing your research, you may not want to touch that one. You may look for a different alternative. This one, finally, before we go on to something else, this is the S&P 500. You can see how well the performance is done over the course of the last few years. Over the last 3 years, a 61% gain potentially. That is monstrous. But this is the 509 top stocks in the market, right? So not as many in it, but ultimately they are the best ones. Again, looking at exposure, you can see a lot of the tech stocks are within that. And you can see how it's just been growing. And the performance of that has been ridiculously good. So again, you can find out all this information and, you've got different kind of sub niches within these. So some of them will focus on different things. Some of them, as I've said, emerging markets, right? You've got dividend ones. You've got the S&P 500. You'll have more around technology. You'll have more around healthcare. You'll have more around different sub niches. And if they do well, they do well. And it's a basket at the end of the day. Before we end though, we need to talk, obviously, this is all about you, your research and why these are good. For me, an index fund is a low-cost strategy enabling you to dollar cost average into something over many different time periods across the course of the year, enabling you to invest in multiple things, not just one single asset. Now, if you are going to incorporate this within a pension, which I will do further videos on, or if you want to do it within an ISA, it's tax efficient, right? It is good for, removing some of that tax edge over a period of time. It's something that I do for both of those. I have an ISA with BlackRock and I have a pension fund with Vanguard. They both use index funds. They are both passive and active in certain ways, different ones for what I've got. But at the end of the day, the more money I put into them and the more growth I get, tax-free, right? And also with the pension, I get money back off the government. I get 20% of my salary. If I'm declaring even more, guess what? 40%. Quite a big number. But at the end of the day, this is not for everyone. Some people want to buy individual stocks. Some people want to buy dividend stocks, which I love. By the way, if you want to check out my Patreon, I will be doing a dividend stock portfolio kind of plan on YouTube over the course of months, but you can see it first in Patreon. At the end of the day, it's down to you. But they are very, very simple to get your head around once you know what information you need. For me, the best websites, well, by far, the main website you're going on, if the investment hub that you're looking to use your broker, look at what's available, take the ticker and Google it. Literally Google the ticker and you will find out all the information you need. The more money that's in the funds, the better. The longer they've been around, the better for data. The brand is also important. You don't want to go for a little small index fund that's just started out. For example, what I kind of showed you. But the likes of Vanguard, the likes of iShares, the likes of Fidelity, all these massive companies, they are good places. They are good places to, you know, look for diversification of wealth. So there we go. A little bit different this video versus my norm, but index funds are relatively simple. Not everyone uses them, not everyone likes to use them. But realistically though, they do well versus the average investor. This is why they've got a lot of money in them. Not suited for everyone. Obviously, some people want bigger gains, but if you've got some money on the side, where would you rather put your money? In the bank and leave it and just let it do nothing? Or would you like to hold a basket of stocks? You will become an investor of everything within these.